Spac Daddy Doug here. Today I have I'm going to be talking about a new Spac that came out, a new letter of intent. The stock price is up 36%, and after looking at the investor presentation, looking at some of the financials, I'm actually really excited about this. So I wanted to make a video to share it with you guys. The ticker symbol is FSRV. FinServ Acquisition Corp, and they are merging with a company called Catapult. But before I get into details, hit that like and also that subscribe button. It really helps out this channel and really helps me make better DD and keep these videos coming. Additionally, anything I'm saying here, just as a disclaimer, is for entertainment purposes. Please take what I say here, but also do your own due diligence. But I'm really excited about this company. As I said, they just had their announcement. They're up 36%. In this video, I'm going to tell you guys why I'm making this video, why I'm excited, who they are, spend a little bit about their financials and why that excites me, what I don't like about the company, and probably how to play it in this market. The SPAC market's changed a little bit in the past couple of months, and then the game's changed. So I want to talk about that too. But why do I like this company? And after reading into it, I realized, hey, this is a great market. It's a newer market. You've probably heard of their competitors and such, but they're highly attractive. They're growing at a really astounding rate, over 100% a year. They're profitable already, and it's very attractive. And they have a very good rate that they're coming into compared to the competitors who are also public. So their competitors are Afterpay, and Affirm is another company that's going to be having their IPO later this year. Right now, you're getting at 14 times earnings. The competitors are 50 times earnings, believe it or not. So who is Catapult? And I'll just start off with their mission statement and their niche. So they are a non-prime consumer POS lease financing platform based on e-commerce. What does that even mean? So I think the two key words are non-prime and lease. And that makes them a little bit different and gives them a little bit of a niche. So what is non-prime? I'm sure you've heard of subprime mortgages, or prime. So subprime are really investors have really bad credit. Prime are investors have really good credit, so 700, usually 700 plus credit score. The non-prime is that group that's just left out. They have like a 600 credit score. They probably made their bills and paid everything, but over time they might have missed some payments, and they have a really mediocre credit score. They're still building it up, so they just get screwed over with credit card debt and such. So that's what makes them very unique in this niche market, is they're able to provide a service where they're able to look at investors and customers and say, hey, they do have a history of paying back, so we're going to invest into them or let them purchase a product from them. The second keyword is lease, and I'll get into that in a second. But what they do is they offer, if you've gone to like a website recently, you purchase a larger price product, and you go to check out on the e-commerce platform, and you type, this gives you an option, type in your credit card or enter a PayPal. And sometimes you might see a third option that says, hey, why don't you do installment payments? That's what these guys are doing, and they're targeting to these non-prime customers. As of already, they have 150 vendors that are on their platforms, big companies such as like Wayfair and Lenovo, and they cater to, I guess, appliances or larger purchase price products. Additionally, merchants such as Shopify they have the capability to add them onto their platform. So really, when you go into their site, you have the option to purchase it. But the difference with a lease, when I said lease, is so when they do those installment payments, technically they are not the owners. The ownership goes to the company. So in this point, it would be Catapult. So it's a lease until they pay it off. So in that sense, if they buy a refrigerator and finance it over 2 years and they miss their payments, Catapult can come back and reclaim that refrigerator, since it's not technically theirs. It's a lease until they pay. Typically, they deal with the $100 to $3,500 range for different types of purchases. And how they make their money is, so typically the typical release that they have is 10 to 18 months. There's a $45 initiation fee that they charge when someone's going to go through financing. And then additionally, depending on when they pay back and the terms they set up, it could be up to 2 times the multiple. So buying a $2,000 refrigerator, that refrigerator at the end of the day will cost $4,000. Catapult will make $2,000 off off of that. And they're set up for match customers, and I'm reading a little bit more into it, and they have like a 3% fraud rate, which is very low, and I think that's good to know. Additionally, they have metrics saying they determine in 5 seconds if a customer is eligible or not based upon their analytics that they run, and looking at customers' payment history rather than their credit scores. Now, I'm going to take a look at their finances, which I find very interesting. So, a new company, so data has only been out since 2019. So, in 2019, they had $92 million in revenue. This year, they have $250 million in revenue. Next year, $455 million in revenue. Now, that just shows me tremendous revenue growth. And I think the years out, 22, 23, it just keeps going up. But their Ebitda, which stands for earnings before interest, taxes, depreciation, and amortization, is the number that you really want to look at. So in 2019, well, they just started. They were $11 million in debt. They lost $11 million, which is fine for a new startup. But this year, they've only been around for a year. They had $40 million in profit. Next year, they're projecting $70 million. So they're already growing, and it's good to be in a company that's not has all this debt. So we know they're going to be growing. The question is how much, and if and how the industry is going to be doing against their peers. So looking at their growth rate against the peers, I'm going to put a little slide up somewhere around here. But they're number one and this is their presentation deck. But when you're looking at it. There's another one that's very close, but it's a new industry doing these types of payments. What I don't like about this company, so the deal itself really values them at $1 billion, just based on the deal, and $400 million was raised, so $325 million is actually going back into the pockets of the founders of this company. So just imagine they created this company. A lot of that money is going back to them. $50 million is going onto the balance sheet, which isn't ideal. But I think looking at other SPACs, obviously you want value for the investors. But take for example LCA, that was money blown away too. Obviously they need to be paid. I think it's a little overcompensation, but what are you going to do? If you don't like it, you just don't invest. Now talk about the stock price right now. So what I have seen in the industry is typically, and then in the SPAC world, is you have stocks at $10, and then a letter of intent goes out and the stock bounces up. So right now we're at $14, and then what you're going to see is the stock price probably slowly go down. And then I used to say, hey, wait until the merger date, and it's going to shoot back up. But what we've seen is it's kind of shoots up with letter of intent, kind of goes down, and then at some point, maybe a month or two before that merge date, then it starts going back up. Not right before. The stock has only been out for 1 day. I think there's a lot of people that are just finding out about this company. And there's definitely, if you guys are watching this too, there's definitely still room to run up. And we don't know. I don't know where it's going to run up to. But I would give it 2 or 3 more days. And if you want to get into it, but just say by Tuesday or Wednesday you might want to pull out. Obviously the macro market on a bigger scale could adjust this too, and how it plays out, but I think there's still a little bit of room to come in, but also don't hold it. It'll probably drop back down, but I do think this company is going to be worth a lot in stock value in the future, depending just based on the numbers I'm reading, and the immediate interest in this company. It's a fintech industry. It's very hot right now, and it's not an industry that's like the EV market that's very saturated at the moment. People are going to be very interested into this, and I wouldn't be surprised if we see $20, $30 stock price, $20-$30 stock price against their competitors. I mean, if you're really looking at the numbers, we can go up to $50 if you're going to do apples to apples in their valuation. Additionally, they have one of their competitors is having an IPO later this year, which could help them up. So I think long term, it's a very, very short term play. Long term, it is a buy. I would probably wait if you're not going to try to get into this train right now. In maybe in a month or so, you could probably get it at a pretty lower price, and then wait for that big rush up right now. But if you like these types of videos, feel free to like and subscribe, and I'll keep them coming. Till then, I'll talk to you.